Welcome back to the Real Estate Jam session. We've got a great one today. Rob Beardsley, he's a founder and principal of Lone Star Capital. They acquire and syndicate multifamily investments. Actually, Rob has also written a book called The Definitive Guide to Underwriting Multifamily Investments. So this is going to be a great video. Make sure you check it out. Let us know what you think. For those of you that are new to the channel, my name is Joe Killinger. I've been a real estate entrepreneur for over 20 years. I've done investing, brokerage, syndications myself actually. So we put a lot of these videos out. 2 to 3 days a week we put videos out. So make sure you go ahead and subscribe to the channel and make sure you also like this video. All right, thank you for tuning in. Today we're going to be talking about multifamily investments and how to write your own multifamily investments. And so I've asked Rob Beardsley. Rob is the principal and founder of Lone Star Capital. Rob is based out of New York, but he's investing all around the country, mostly focused in Texas right now. He's also the author of the book, The Definitive Guide to Underwriting Multifamily Investments. Rob, thank you for coming on today.
Yeah, thanks for having me on the show.
So multifamily, how did you get started? What was the aha moment? I got to invest in multifamily.
Yeah, so I had a pretty interesting start in real estate. Like we were talking before we hit record, I grew up in a real estate family. My dad tells me that he was bringing me on to construction sites when I was in diapers.
Right.
So kind of had that good background, but it was all in residential single family. My parents used to run a residential brokerage firm in Silicon Valley, buying and selling luxury homes for their clients. And then on the side, they did some fix and flips and development. So growing up in Silicon Valley, I was pushed more towards the tech side, even though I grew up in a real estate family. So I didn't really show that much of an interest in real estate growing up, but I was around it, soaked it up, and really learned more than I gave myself credit for. But went to college for computer science, thought I was going to go the tech and consulting route. And while I was in school, contemplating all the millions that I would make in tech, I thought, well, what am I going to do with all this money? How am I going to invest it? Is it the stock market? Cryptocurrency wasn't even really a popular topic back then, but yeah, it was the stock market, real estate. And I gravitated towards the tangible income producing nature of real estate. And so I started looking at real estate. Obviously was very familiar with single family and how that world works. So when I discovered multifamily, that was a no-brainer aha moment. I thought, wow, this is scalable. You know, I like to think big and long-term. And so that was multifamily is a great asset class to align with those goals, where I can, not only build scale as far as the investments, but I can also build scale as a company, because we can have large enough assets and portfolio size to bring in a strong team around us and do things bigger than ourselves.
Right. Yeah. Now, so how big do you have a pretty big team now, or you do self-manage, or you do third-party management?
So we recently brought management in-house just earlier this year. So that was an effort that has taken place over the last couple of years. So we have about 25 on-site employees across the sites, across the portfolio. We have a VP of operations based in Texas. And then there's 4 of us in New York that run, the corporate investment team, which is made up of a director of acquisitions, an asset manager, and then myself and my business partner.
Okay. Now, how did you guys start? I mean, obviously you had to start raising money. Did you guys raise money, or did you guys have money to self-start? How did you get your start?
Yeah. So, starting out, we got our first deal under contract while I was still in college. And then I ended up dropping out, taking a indefinite leave of absence.
Yeah.
And at that time I had 0 money. So it was all about raising capital. And, so we had to raise money for the deal itself, raise money for pursuit costs every step of the way. So that really forced us to build up our network quickly. Which I think necessity is a great mother of invention. And
it sure is.
I certainly didn't have a robust investor network prior to our first deal, and I'm still currently building one. But that was a eye-opening experience, to say the least. where I think everybody in this world underestimates how difficult raising money is. You kind of assume, oh, well, it's a good deal. It's a good idea. It's going to make them money. They should invest. But really getting people to trust you and part with their money, especially considering all the options they have to do with their money, it's very tough.
Oh yeah, yeah. That first meeting, you really walk out of there. It's the best. Starting to take those meetings is the best lessons you're going to get, right? Because you go in and they start asking you questions you probably didn't think about, and so it's always, first of all, it's how much skin in the game. So that's something that we always hate to answer that one. But now, so you had some seed money. Now, did you syndicate these things then, each property, or you create a fund? Okay.
No, so we've raised capital on a deal by deal basis. So we identify the property, and here's the fun part, right? As you know, you put the property under contract with no money in the bank, and then assuring the seller that, hey, I'm going to go and raise 2, 3, 4, 5, $10 million. And then you have to race against the clock to get it done. So that's what we've done. And so far it's been successful, but it certainly hasn't been without its challenges.
Right. Now, how many deals have you guys syndicated so far?
So we've syndicated, I think, 6 deals now.
Okay. All right. Now let's talk about your underwriting. You've written a whole book about it, so I know that you've got some good experience here. Why don't you walk us through your book and what you touched on in the book?
Yeah. So the book, for those that don't really know what underwriting is, it's all about the evaluation aspect of multifamily investments, right? So it doesn't matter what you're investing in, there always has to be some sort of analysis. And with multifamily, it's not terribly complex. We analyze the revenue, expenses, growth assumptions, debt, and then your future sale assumptions. That's really all the pieces. And what that allows you to do is make a decision about any given property, whether you are interested in buying it and at what price you'd be willing to buy it for. And so that's a critical component of this business and something that we focus on a lot. We underwrite hundreds of deals per year, and a full underwriting takes multiple hours, and we do rent comps, sales comps, and put budgets together for CapEx, which, your construction budget and things like that. So that's something that, you just have to get right. So
do you guys do, when you're acquiring assets, are you looking for fix and flip? What kind of assets are you looking for? Already stabilized?
So we look at properties kind of up and down that risk spectrum. We have a strategy which is more core plus, where we look to identify stabilized properties that are well located and are poised to have strong performance over a longer period of time and can produce meaningful cash flow day one. And so, that would be our core plus strategy, which is more focused on cash flow rather than appreciation. But then also we've been very successful in acquiring underperforming properties that have very high vacancy, down units, bad management, low rents. Right. So going in like that, and that is more resembles more of a fix and flip situation, where you can buy it, fix it, and sell it, or you can refinance it at that point and then hold it as a stabilized asset in your portfolio.
Yeah. Now, do you guys have targeted returns you're looking for, or you just go by market? How are you guys targeting it?
Yeah. We are very sophisticated and explicit with the returns that we target. So, I could say, oh, well, we just look for 15% return, but it's much more granular than that. We look at all the aspects of the deal, as far as the quality of the location, the quality of the property itself. When was it built? What kind of systems does it have? The risk of the business plan, right? Obviously, if you're buying something with a great in-place cash flow and your plan is to do nothing with it, that's a far less risky deal than if you're trying to buy a half vacant property and you need to turn it around and double the NOI. So we don't grade those equally, right? So for the heavy lift deal, where we're going in there and raising rents 20% and increasing occupancy from, let's say, 70% to 95%, we're going to demand something closer to an 18% IRR for that deal. Versus, like I mentioned, if it's a deal that's well stabilized, great location, newer asset, we might accept as low as a 12% IRR if, like I said, it truly is in a great location and checks those boxes. So it's kind of a range from there. And so we're always looking at different aspects of the deal and saying, well, the deal's location is X. How does that influence our return hurdle that we're looking for?
Yeah. Now, do you guys focus on anything like some people are buying multifamily assets now near colleges, or stadiums, or transportation hubs? Is that something you guys focus on, or you're just focused on wherever you can find a deal?
Yeah, that's more so the latter. We are bottom up investors for the most
Okay.
part. Obviously, we don't look all across the country and we're not willing to look at every deal everywhere, but once we've chosen a market, which for us is Texas, and more specifically Houston and Dallas Fort Worth, within those markets, we're willing to look at any deal, because if it makes sense bottom up, then we're ready and capable of executing, because we have the team on the ground to do so. So kind of going back to the risk metrics and the return hurdles, right? We may find a deal that is not in our most favorite part of town, but if it has a price that allows us to get to a certain return, then we're okay with it.
Right. Yeah, we had our best deals that we were doing. We were investing in multifamily. We're in lower income areas, a little bit higher risk, but we were able to re-tenant them. Now they are a little bit more labor. You have to hire, you have to have a little bit more staff, but we had to have security in some of the places. But we got better returns in those areas, and the tenants seldom move. It was great for us. Now, how are you sourcing your deals? Are you going through the brokerage community, or are you talking to banks? How are you guys doing it right now?
I would say at least 95% of our deal flow is through the broker network. We
Okay.
maintain relationships with all the brokers and keep tabs and make sure that we're calling them on a biweekly basis.
Yeah.
And yeah, that's the name of the game for us. Sure, we do see some deals which are direct to seller, so we get
Sure.
contacted by a company that is looking to sell, and those don't necessarily mean that they're better deals or anything like that, but it is still nice to get those looks, and we appreciate that, and we're looking for that. But I think if you really want to build a business with enough volume, then you really have to make the most of your broker relationships.
Yeah. Yeah, I agree. We've got deals that, when we bring on multifamily, I mean, the market here in Los Angeles is pretty hot for multifamily, and people are coming in, putting a couple 100,000 down on a $3 million deal. That 200 grand is hard immediately. I mean, it's liquid. They're done. It's here. It is. I want the property. If you take my offer, here's your 200 grand. Are you guys seeing that around the country at all right now? Outside of
Absolutely.
the, are you? Yeah.
Yeah, that's table stakes in Texas. Your offer will
Yeah.
seldom be taken seriously without fairly
Mhm.
substantial hard money. To win the last few deals that we are currently doing has required us to pull some strings and put up substantial hard money. Upwards of $500,000.
Oh, liquid right off the bat, or no? Yeah.
Day,
Wow.
day one, yeah,
Ooh, that's painful.
yeah.
That would cut back. You'd really want to make sure your underwriting spot on then. All right. So walk us through now. What are the first, I've got some, we've, a lot of our subscribers are newer investors. What are the first things you guys look for? So a broker brings you the deal. You look at the demographics in the area. You look at, do you guys worry about traffic count or anything like that?
Not so much about traffic, but definitely demographics. So what I'll tell you is people ask this question all the time because everyone wants to figure out ways that they can spend less time looking at deals, right? And and
Yep.
and turn through
There's
deals.
no
And so,
shortcuts though,
right, there is no
as we
shortcut.
know.
And
Yeah.
so the rather than trying to shortcut the financial analysis, it's better to upfront look at more qualitative things like what you said, which are median household incomes, median home value, quality of the schools, and just getting a sense of the economic drivers of the area, because those things you can just look at right off the bat and it can give you a sense of the market. Also, a big one for us is population growth, obviously. And
Yeah.
lately, we've been paying attention to the CoStar rent growth projections. We're not going to live and die by those, but it's helpful to see that as well. But I think the population growth, which is a more core metric, right? And then rent growth is a an outgrowth of population growth,
Sure.
assuming supply is held in check, right? So looking at that core population growth is really key, because you could spend hours underwriting and looking at the deal and everything, but if population growth is negative, then you probably shouldn't have bothered with all that
Yeah.
analysis anyway.
Yeah. You need to know that before you even start going into areas to invest. I mean, I was looking at some numbers in Austin, Texas, and you guys aren't looking in Austin right now, are you?
No.
It's crazy there. The numbers that people are getting is like it's like California. And
Yeah.
I'm like, my concern there is the infrastructure is pretty tough there. They weren't ready for this kind of population influx, right? So, people are going to start moving out a little bit. I think they'll get tired of that eventually, but I don't know how it's going to affect rents. Now, did you guys buy a lot during the pandemic, or did you guys kind of sit tight?
We absolutely should have, but
Yeah,
we
hindsight's always 2020, isn't it?
yeah, absolutely. So when the pandemic hit, we were obviously mostly concerned with our portfolio. And so we were making sure that our assets were in the best position to weather whatever storm that was coming. Obviously, we had no idea what kind of storm was coming. So we were planning for worst case scenarios. We were having calls with our major investors and just discussing what sort of contingencies we should be planning. And then, we didn't want to have any bridge loans on our books at that time. So we refinanced any bridge loans that we had. And then, and then we sat tight as we kind of were looking for COVID discounts that never
Yeah,
materialized. But if we would have had guts, I mean, pretty much as has been the case over the last 10 years, if you'd have just had the guts to buy, you would have done well.
yeah.
So it's been, it was a tough time for us for sure. But then we sprang back into buy mode in 2021.
How did you? Yeah, yeah. I think if you know, it's always scary because this was all new for everybody. Nobody knew how this pandemic is going to play out. But man, it had been there's some key assets came on the market in where we're at in Dallas and here in Los Angeles, and we didn't pull the trigger on them because you know are people going to continue paying? Getting the financing was going to be tough. Getting a bank to really do it was going to be a battle, but yeah, I really wished we would have been able to pull the trigger on those. But all right, so now, you know, people are watching this channel because they want to become a real estate investor. And, syndication is probably the best way to go about it. I mean, you went out, you've got your properties. How did you find the investors to syndicate with? Through your business partner, or you guys just start door knocking and cold calling, or how did you guys really, really get started?
So we were both extremely fortunate to have, I would say, pretty strong family and friends networks.
Okay.
So based on my family's 30-year-old business in Silicon Valley, just servicing those clients all those
Yep.
years, never asking them for a dollar. And then, so it was I mean, certainly it was hard, but I can't just say, oh, I did it all on my own, right? I just had this
Right.
awesome network where I could say, oh, hey, I'm my parents' son and this is what I'm doing. And can I have a call with you? Right. So really, really fortunate to have that built-in network to be able to, yeah, sure. Maybe not all of them invested, but just having them there to try was
Sure.
great. Right. And then same thing with my business partner. He was a tax attorney at MetLife for 10 years and had people at his company and just had a general network that was fairly wealthy and actually already investing in real estate. So that was helpful. But with all that being said and all that head start, it runs out pretty quickly.
Yeah.
Anyone who really wants to make a business out of this, you unless you have a rich uncle, right? That famous rich uncle, you're probably
Yeah.
going to run out of money very quickly. So once, my advice to people is once you run out of your family and friends, which I don't want to minimize that, like, oh, well, you just talk to your family and friends and get money, right? That takes
Sure.
effort
Yeah.
too. You need to have your deal together, have your team together. Everything has to be in order, and you have to know how to sell yourself and your investments. But once you get past that point, then it's all about building your broader investor network, and that's many ways to go about it, right? People back before social media, they would press the flesh, they'd go to conferences, they
Yep.
would go door to door, they would show up at law firms and talk to wealthy lawyers and doctors and whoever they could. But I think these days the best way to go is social media and content creation. It's such a scalable and valuable way to go, because you're actually by doing social media, you're actually giving back to people, you're providing information, and it's a symbiotic process, but it
Sure.
doesn't happen overnight. It's not the fastest way to raise money, but it's probably the most effective.
Right. Yeah. It can be a battle. Don't you think that I mean, obviously, like you said, you're fortunate you had those contacts. If I want to syndicate the deals, don't you start off smaller? I mean, what was your size first deal that you did? What size was it?
So to test the waters, the very first deal that we did was one that actually wasn't our deal, right?
Okay.
We had a partner who we knew through a mentorship network that had a deal already closed with his own capital, and now he was looking to recap with some investor money. And so we felt very good about the basis, but the business plan. We also liked that the sponsor had the capital and conviction to close the property on his own with his own capital, and then now is a recap scenario. So all that made sense for us. So it was a very manageable raise of $500,000. So
Okay.
we held a conference call, invited investors to join on, and in that evening of after holding the call, we raised all the money. So we thought, oh wow, this is great. Maybe this
This
isn't
is
so
easy.
hard. This is easy.
Yeah.
So we subsequently to that, we were starting to look to do our own deal where we would be this lead sponsor, management would be on our shoulders and everything. And we certainly weren't looking for a very large property, but one had come to us that we couldn't pass up. And so we took on a larger project and ended up having to raise $4.5 million on our first official deal.
Oh,
And it was big, too big.
yeah. That's daunting taking on something that big, that new to it.
Yeah. Yeah. And so that's where the growth comes, and that's where the struggles come. And
Yeah.
uh, grew the network very quickly. Pretty much asked everybody I knew to pitch them the deal, and then ask them, who do you know that I can talk to? And just driving the network and trying to get in touch with as many people as possible. It was a tough experience. I'm not a natural born salesperson, and I don't think anybody really loves the idea of just cold email, cold calling and
Oh
whatnot,
yeah.
but you just have to check your
Oh
ego at the door and just make it happen, right? There's a big task at hand, and there's no room for your feelings.
yeah. You gotta. What we tell our people here is that you're just building a relationship. Maybe it doesn't work on this one, but build a relationship with them. You go out and do your deal, show you're successful, come back to it. I mean, for every no, I mean, you're going to get a lot of no's, right? I'm sure you got 95% no's, and then that 5% invested with you, and then here you are. But there's going to be a lot of no's that you're going to have to do. But I think if somebody really wants to get started, smaller properties would be the way to go. Raise a few $100,000 here and there through friends and family if possible. And but I think multifamily is going to be everything I'm reading. It looks like for the next few years, it's going to be flying high. Don't you agree?
Yeah, I think certainly over the next 24 months, I don't see any major issues. Obviously, we have currently inflation happening in a big way across the economy, and that is including rents, which
Yeah.
is good for multifamily because the negative aspect of inflation as it relates to multifamily and all investments is the pushing up of interest rates, which then affect valuation, right? So we're not seeing that yet. Right now, we're just seeing it affect the revenue side of things, or the income side of things, because your expenses are going up, your income or your revenue is going up. And fortunately for multifamily, revenue is going up much faster than expenses.
Right.
And so that means NOIs are increasing right now while cap rates are staying very low. So values have done nothing but go up. And I don't know if I am really betting that they'll continue to go up, but I think that they'll stay relatively stable, which that's all we can ask for.
Yeah, I mean, I just did a video that I think we're posting it next week on the channel, and it's how real estate is a good hedge against inflation. And so I'm with you. I think it's a great way to continue to battle this inflation, and hopefully they get that under control fairly soon. But Rob, thank you very much for coming on today. I think our viewers got a lot out of it, and if they want to reach out to you, I'm going to put your contact information below. And for those of you watching, thank you for tuning in today. Rob is, I want to make sure you get his book, The Definitive Guide to Underwriting Multifamily. I will actually, Rob, if you can send me a link to it, I'll link to that as well so they can get your book. And we'll see you. Rob, thank you for coming on, and we'll see everybody again next week.
Sounds good. Thanks.
Thank you.